right. Hello. Good afternoon, BlockCon. I have the honor to be the first speaker after the lunch break. My name is Martin, and I'm going to talk about algorithmic trading and how to bring it to the masses. Quants are the rocket scientists of Wall Street, says the New York Times. I'm the CEO and founder of QuantX and a veteran quant myself. Quantitative finance is an $800 billion industry. Oh, actually, we're here. Yeah. It's an $800 billion industry. Over 85% of all transactions on exchanges today are already made by algorithms. So the future of trading and asset management is clearly quantitative. What is trading algorithm? Trading algorithm is a computer program that predicts the prices of assets traded at exchanges based on a mathematical formula and executes these predictions automatically to trade the markets. Algorithms are usually built with sophisticated software like Python, MATLAB, and R, and using sophisticated libraries like TensorFlow, MLPack, or Caffe. Quantitative finance, despite the broad availability of all these tools to anyone today, is still in the hands of a few and very successful quantitative hedge funds like Renaissance, Winton, Two Sigma. The secret to their success is pretty simple, pretty straightforward. They each employ hundreds of mathematicians, physicists, computer scientists, quants in short, to create trading algorithms for them. And then they market that as a hedge fund product. But all their quants taken together make up for less than 1% of the quant talent in the world. There are only 10,000 professional quants in the industry, but there are 20 million people in the US alone with a science and engineering degree who could potentially become quants. So what about the 99%? What about the 99% of the talent, of the quant talent in the world? We empower them with QuantX by providing them with the infrastructure that they need to build trading algorithms. That consists of software, of data, and of course, most importantly maybe, access to investment capital for their trading algorithms. Our mission is to democratize quantitative finance. We have a quant network of over 9,000 quants worldwide, so by the end of the year, we will have more quants on our platform than the entire industry has together. And again, our mission is to democratize it, to bring it to the masses. So we have two different types of users of our platform. The first ones would be quants, and the second ones would obviously be investors. And I wanted to show you today how easy it is actually for any one of us here in the audience to become a quant and to build a trading algorithm, actually even a trading algorithm that has the potential to beat the stock market. And that's what I'm going to do in the next 4 minutes. I will show you how easy it is to develop such a program using our tools. And then I will focus on how can we bring these algorithms to investors? How can we connect trading algorithms generated by anyone here in the audience, anyone in the world, to investors? So, in the next minutes, I will develop together with you a trading algorithm, a very simple trading algorithm, to give you an idea what a trading algorithm is and how easy it is to develop one. I will develop a very simple algorithm that's only based on historical price data that does not need anything else but its own historical prices for its predictions. I will go with the default settings here and develop an algorithm that trades commodity futures, index futures, bonds, interest rates, energy commodities, precious metals. I will skip currencies and agricultural commodities for this part. We have tons of more data that one could use, but let's start with something simple. Down here, we can see the source code, the logic of this code, of this trading program. And the entire logic of this algorithm is in these 12 lines of Python code. It's a very simple and straightforward algorithm. What we do here is we compute two moving averages, so two average prices for every market. One time we average the price of a market over 200 days, and then we average the price of the market over 10 days. We compare those two averages. If the shorter term average, the 10-day average, is above the 200-day average, that means prices have risen recently. And since this is a trend following example, we want to be invested long in a